Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, October 11th, 2024. S&P 500 currently sitting at 5813. I'm David Zarling. I'm here with Ian McMillan. This is episode 225. So I think we'll dedicate this to Baton Rouge, Louisiana.
Is that
Ragin
the
Cajuns.
area code?
It is. I just know area codes off
Baton
the top of my head. Yeah,
LSU. They got good football down there.
they do. Is that considered a rival? Or is it more Clemson?
No, Clemson's our rival. Second rival would be second rival for Gamecocks, I guess, would be Georgia.
Okay.
Georgia fans would scoff at that, but emotionally, that's who we care about.
No, I
But
get it.
they've messed up, so we don't have the divisions anymore in SEC. So you just get like a random schedule.
Oh, that's interesting.
Yeah, so it's not like we play Georgia every year, or Tennessee, or Florida. In fact, we didn't play either of those three teams this year.
So what's the rotation like? Are you playing a team every 3 years or every two?
I don't know. I haven't looked at.
Okay.
I'm gonna set it up.
That's interesting.
Hey, you said 5813 for S&P.
Yeah, 5813.
I don't think we've ever started this podcast with a 5 and an 8.
No, we have not.
That would mean yes. If you heard that, that does mean we did get another all-time high this week, and got a couple of them, including today. So Wednesday we broke out to fresh all-time high. Pretty short consolidation up here. I mean, right? We've been above these, earlier about 3 weeks ago. We got above the July highs and kind of just been slowly meandering upwards.
We had the VIX move up to 20. And here we continue to, and I know you've used this term before, melt up.
Yeah.
Since recording that 20. And we're going to be recording for the 45th or 46th new all-time high for the S&P in this year.
And
so
they always happen in bundles, right?
Yeah, they do. They happen in groups, bundles, clusters.
Yeah.
Yeah, that's an uptrend behavior. New highs beget new highs, regardless of the narrative, regardless of the bricks in the wall of worry. This is what bull markets do by very definition, is that there's demand outpacing supply, causing people to pay higher prices. And I know in episodes earlier this year, it's still an interesting spot because the sentiment is not by the dip. The sentiment has been skepticism, right? If you think
for sure, still skepticism.
You're in a world of hurt if you're trying to figure out how to get involved in this market. And if it continues to move away from you, right? Because John Templeton, great investor, we've talked about this in the past. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. I'm sure there's people out there that would be like, oh, we're at optimism. But not when you are aware of what the narratives are, and not when you see the VIX where it's at, and not where you see where people are actually positioned.
Yeah, I think there's still a lot of 5% on a T-bill is safe. And that's cool. It is safe. That is, it's not a fake statement. 5% on a T-bill feels incredible, but the opportunity risk is
there's an opportunity cost. That dollar has to go somewhere. And you could definitely do T-bills and get your guaranteed 5%. But then where has that left you since October of 23, when we saw the breath thrust, we saw a 5-day close above a 200-day moving average and hold it. Been one of the best election years,
Yes.
you know, the first 9 months.
We skipped September, and we talked about this in the September client newsletter. Like, hey, be aware. Could be a rocky, weird month. Was for like a few days, and then we talked about it again. Like, hey, never got the seasonality. It has been a very good election year.
In fact, Ryan Dietrich has it as the best first 9 months of an election year ever.
I don't know. Maybe they're pricing something in. Maybe they're excited for something. Maybe and you can price something in, and then I'm through November 5th, and then November 6th, we start. I mean, I'm open to that. I mean, I'm always open to anything. So I guess election year wouldn't be super different to that.
Right. And when we look at, like a Bank of America Global Fund Manager survey, and I'll send this to you, Ian, in our internal chat here so you can see it. The positioning that we're seeing by institutions is actually what we saw coming out of the bottom. It's almost a negative risk taking. And so you have skepticism in this market.
For sure.
And you have more money going into money market funds. And that the mechanisms behind that could be multiple.
Yeah.
It could be people thinking it's too high risk to be in the market. It could just be reallocation of those who are deep into retirement into more safe haven type vehicles. It could just be the fact that we have the largest working force we've ever had that's putting money away, and an allocation of that is going to money market, which is, you can now get 4 or 5%. That it used not to be a thing. But it's not like we've exhausted the fuel that's sitting on the sidelines.
No, for sure not.
And this is happening in the backdrop of a breath thrust last year, October, November, an echo breath thrust in July.
Yeah, and then in July, and then we went sideways after that. Fair.
Yep. That's typical after breath thrust is you have this sideways, but then I think you've highlighted what you see 9 to 12 months into the future. Well, here we're on the cusp of that, right? We're on the cusp of being 12 months removed from the initial breath thrusts, and the data was on point again.
I remember April being weird. Again, when we pull up the stats and we look at these thrusts, and Dietrich is great at this, when we look 6, 12, 24 months out, how above average bullish these markets tend to be. And we get to a correction in April, and we're like, oh my gosh, is it going to roll over? It's like a fair mental. I mean, Halloween 2023 through March 2024 was Russell 2000 had its 7th best 4-month rally in history.
Right.
We had so many, call it a price thrust. And yeah, in the big picture, we're still working, although, and I think Dietrich also said this. Someone out there, please let me know, send me a DM, whatever, you can comment on the tweet, that this is actually a below average start, off of a cyclical bottom.
Right.
So I think we're up 72% off October lows. So
from
basically
22.
So we're basically coming into 2 years off the lows. On average, we're up 86% at this point. I think I read something like that from him a few days ago.
So not too far too fast.
No, it's not too far too fast.
It's below average.
It's technically below average. If this turn and this it's most likely a new multi-year bull market. We've said that many times.
Yeah. And so when you paint the backdrop of these two breath thrusts, the below average return from a cycle low, you have rising 200-day moving averages across the board. And then you add in the following factors, which is breadth is not extended, meaning something like a bullish percent for the New York Stock Exchange is sitting at midfield. So it's not like you're sitting on the goal line. Then you add in bucking the September trend of negative seasonality for the market and actually being positive. And are we going to do the same in October? Time will tell. I mean, we have a lot of time left in the game for October, but October is historically negative in election years and in a 4-year cycle.
We're not off to a bad start, though.
Correct. So is the seasonality wrong? That's not the way to look at it. The way to look at it is that's what has happened in the past.
Mm-hmm.
Doesn't have to happen in the future. And when it doesn't, that's when we should pay attention. And the flip side applies too. November through April, a notoriously strong 6-month period. If we're not strong during that period, that's something to pay attention to as we head into summer of 2025.
What if that's one of those relationships? Like, it's like, what if we get to, we're 10 years into a rising rate environment and we realize that May through October is now the most bullish 6 months?
That's fair.
Wouldn't that be fascinating?
It would be fascinating because you've highlighted on here in past episodes that here are the things we know. When we look at history, we're historians, we're market historians, that interest rate cycles are typically 35 to 40 years. 1980 to 1982 was the peak of the previous interest rate cycle. We headed into the next interest rate cycle of lower rates with the time ticking and coming up near 2020 for that. And wouldn't you know it, we've seen higher rates since 2020. If we are truly in a new 35 to 40-year cycle, your point simply is, Ian, is that these relationships that have existed for 40 years, they just need to be viewed through a different lens.
Yeah, I just don't think that you can rely on, I mean, interest rates just impact so much the fixed income market, and what people pay for debt has such massive ripple effects.
Yeah, it's the cost of money.
Yeah, and that is, I mean, I'm genuinely up for absolutely any relationship flipping 180. And like when I say relationship, this cause and effect of when X does this, Y does this, and that type of thing. And it's fair. A lot of our industry is built, right? You want to look at like, okay, historically, what has happened? I think that leads to I think it's a fair way to look at it. I think it leads to a lot of good decision making.
Well, a major pillar of our industry using buy and hold is the 60-40 portfolio.
And look at
40% of bonds we're supposed to offset or de-risk or de-beta the 60% that was exposed to stocks. But now we're seeing beta out of bonds that's greater than stocks. And here we have stocks going to new all-time highs. We are not seeing that out of bonds. Like quite the opposite.
We talked about this in the client letter, right off that rate cut in, what was that, like mid-September? And you've got, I'm looking at TLT. So the most affected, the further out you go on the duration spectrum, is always going to be more sensitive to interest rate movements. I mean, they said they cut rates, Dave, so I assume bonds. I mean, what a boost for bonds. No, not a boost for bonds.
And for perspective, for our listeners, we're talking about the S&P 500 going out to new all-time highs, along with many other instruments, equal weight.
Yes.
You name it. TLT, a good proxy for measuring 20-plus year treasuries, is still 45% down from its highs in 2020, which means for the coupon for the purchase to get back to the highs. So I just mentioned equities are at all-time highs. It would take 83%.
It's going to take a while when you're in fixed income.
Right. And so we are in a different environment where the 64-40 portfolio is broken. It's done.
It's done. Like, I don't know what else to tell you. Moving to quote unquote fixed income when stocks get rockier in a downtrend. I don't think it's an option anymore. I mean, TLT down over 8% since the quote unquote rate cut. But rates had been moving up into it was a very well assumed message that we were going to get 50 basis point cut. Some people thought 75. We did get 50. And it's tanked. When you look at TLT versus S&P, we've got fresh all-time lows. Do I want to be in duration? Treasuries of all things. Well, I was going to say, to your point, there's so many things confirming on the equity side. You mentioned EQAL all-time high. We talked about the Dow, S&P. I'm pretty sure NYA is there. And I'll tell you what, Dave, and this is fascinating to me. Mike Zaccardi pointed this out earlier today. So to recap, we've just spent the last 30 to 45 seconds talking a lot of bullish stuff about equities, all-time highs, right? Over the last 3 months, Dave, there's been one negative sector, and it is the most important sector. Well, it's the highest weighted sector, so I'll call it the most important. I'm still going to call it the most important. This is your Giannis. This is your
technology.
This is your Sam Darnold. And Sam Darnold. Imagine if Sam Darnold was on the bench and y'all were still 5-0.
Yeah, we'd be.
That's what this should feel like to equity investors.
Yeah,
tech is the only negative sector over the last 3 months, and we still continue to grind higher.
That's a testament to breadth, right? To your point,
huge testament to breadth.
The team as a whole is strong, and that's great. And we've got technology now sitting in the hip pocket. I don't know if this is the turn, where we start to see value over growth. That's not necessarily what we're seeing in the charts, but your point is extremely valid. Yes, you can have bull market characteristic be tech is leading, but we're also seeing other things lead that are not risk off. Past 3 months, what are some of the top sectors? Is it like
top 3 sectors over the last 3 months?
Right.
So utilities, industrials, real estate, financials right there. Those are kind of your top first cluster.
And some people think of utilities as being defensive, but industrials and financials, like how bad are things if financials are leading? Shoot, there was almost a full decade where financials led in a previous cycle in the mid 2000s. That was extremely beneficial. And should we be surprised if we're in a rising rate environment that financials would do well?
Financials, they are. And you look today now, on a relative basis, we still got some work to do, but regional banks, I mean, we're there. We're grinding through, and you'd mentioned this before, but regional banks still trying to work themselves through that mess from March 2023.
That was that 1 in 3 million year event that shouldn't, quote unquote, we know it can happen, but statistics would say it shouldn't happen. But that's like saying on the planet Earth, there shouldn't be a 100-year event. Well, if you're looking locally, if we're just looking at Baton Rouge, yeah. If we look at the globe, yeah, once a year at minimum, you're going to get a 100-year event. And we had a once in million year event in regional banks and financials back in March of 2023. And here we are back to that level in regional banks, pressing up against it and chewing through that supply.
It's been an 18-month grind.
But you use something like KRE, if we're clearing 59.60, or you use IAT, we're clearing $50. That's a really strong area. And again, I'll say when financials are doing well, and it doesn't have to be on a relative basis, just on an absolute basis, that's risk on behavior.
It is. And your bigger banks, right? So if you want to look for clues, right? So it's like, okay, well, let's see what some of the bigger or some of the stronger regionals are doing. I mean, we do have multiple regionals looking strong. You've got your JP Morgan likely going out to I mean, close to all-time weekly highs. Bank of America continues to hold up above, this $37 area. So the big banks look fine. I mean, we mentioned, what was it was utilities. Utilities the best sector over the last 3 months. Hey, 03 to 07.
I was going to say, so
It's not sexy. It's not fun. It's not Amazon. It's not Apple. But it is what it is. I mean, it's the strength.
that's where the strength is. And it's not staples.
It's not staples.
You look at staples and I'm not saying you need to buy utilities because there's an opportunity cost there, meaning versus the S&P. But the fact that it's doing well isn't by itself risk off. And again, I'll go back to what you highlighted before. If we're in a new 35 to 40-year interest rate cycle, we're going to see continuing rising rates. Do we really get to be surprised when some of these relationships change? And I know before we hopped on here, you were talking about if you look at Treasuries versus the S&P and you compare that to gold versus copper, so we've got two ratios there. You stack them next to each other, highly correlated for a long, long time.
I totally understand why for decades this was a fair risk on, risk off ratio. I get it.
Yeah. You're not saying it was wrong. You're just saying that, hey, we have to be open to the idea that an interest rate cycle changing, and this is what's fascinating about all things in life, to be honest with you, is that when there are cycles that exceed the investable lifetime of someone or someone who's managing money, if you don't have a way to identify when that's changing, you might spend a decade struggling because you are living under a different paradigm.
Yeah, you're just churning your wheels of why. And it's hard. I mean, I think it's also hard to go beyond, like, if you want to know if you should own stocks or bonds, look at the chart of stocks and bonds.
Right.
I get that there's highly correlated things and it's cool, but if we want to be literal about what should I own, stick to those two assets. This would have told you to be long treasuries for the last 3.5 years. And what has that got? And treasuries have underperformed the S&P over that time frame by 49%.
That's the very definition of opportunity cost. And if you have some type of mandate where, let's say it's a fund or any other scenario where it's a mandate and you have to own credit, well, then do that top-down analysis. If you can get 5% at low risk or no risk, you have to start there. And then when you start doing the analysis of the entire aggregate bond complex, which is much larger than equities, and you look at something like AGG, and then you start comparing things to AGG, what are the things that are doing better than AGG? It's things like convertible bonds, junk bonds, high yield bonds, emerging market bonds. That's risk on. If you have to own bonds, you're taking on the riskiest parts. And that statement alone could probably give some people some, like, why would you own the riskiest parts? Risk and return. How much risk am I taking to get the return I'm getting? And right now, it's actually more risk to be in long duration government securities than it is to be in some of these high yield instruments or convertible bonds.
I mean, look at high yield spreads. They've absolutely collapsed.
Yeah.
Lowest since summer of 22. I love looking to the fixed income market for clues. I absolutely love it. And I mean, it continues to give the, hey, full steam ahead.
It's screaming risk on. The credit market is screaming risk on. And wouldn't you know what, equities are following that.
They are.
The instruction. And so sometimes for the past few weeks, it kind of feels like we're saying the same thing. Are there any things, Ian, that you're looking at that the risk on thesis would be under question or be refuted? Because in the end, that's why we use technical analysis, is you have a thesis, price either confirms that thesis or denies it, and you position accordingly. So is there anything that you're looking at that you say, okay, if we're below this price level, it could be relationship, it could be a broad market, it could be certain leaders that you're looking at. What are some things that you're looking at that say, okay, we have this risk on thesis, we have the credit markets that are confirming that thesis, but oh, we have some things over here. We just got to keep an eye on them because they might refute that thesis.
One, and I've mentioned this really a few times over the last couple months, high beta versus low vol, that really continues to fix itself. We are actually back in this channel. I mean, it's a more sideways relationship than I'd like it to be if I was being super greedy. But it has fixed itself. The one that you mentioned it looks exactly like it. J&K versus AGG has fixed itself. And I'm using that without the dividend. Like if you've got total return in there, amazing. I mean, yeah, now you've got J&K, AGG breaking to new highs. 6 months ago, I would have had a little bit more of I'm not going to call it a red flag, orange flag over this whole, like, you just told me 20 minutes ago that but look, the tech is the one negative sector over 3 months. But look what we've done since then. We've continued to grind higher on an absolute basis. Pretty much everything's holding up. I don't have a lot in my orange flag, my red flag folder. Like I would have had yield. We've talked about yields, spreads. I mean, so now that's been removed from the, I'm not going to call it the worrisome bucket, but it's been fixed. It has been. A lot of things have just been fixed. We might not have had a breadth thrust, but you alluded to this when we were offline earlier, like this whole idea of the fact that we have moved higher without mega cap tech performing is I consider it a breadth thrust. There's probably no way to define that or whatever, but I consider it a breadth thrust. And just the participate. What do we always say? Like, okay, well, if mega cap tech's going to sell off, then a lot of these other things have to step up to the plate and play ball. And they did.
Yeah, correct. They stepped up and made the plays. And I'm with you. Like, tech not leading or tech being a current opportunity cost, but the rest of the market going to the upside.
Play and you just won your first round series 4-1.
Yeah, it's a great setup. And do we really get to be that surprised when we knew that the weighting of tech, right? Because it's based on momentum and based on the big get bigger. Tech was sitting at the largest weighting we've seen historically for the S&P, using that as a metric that we've seen in a while. Do we really get to be surprised that it pauses using something like XLK versus S&P at the levels it was back in the year 2000? And is that regime shift where we do start to see leadership from other areas because we had hit that resistance point, we had reached that relationship point where other things had to step up, and they did.
They did.
Could that be the midpoint of the cycle? We typically see equities move in 3.5 to 4 year cycles. Downside cycles, we typically see 1 year to 2 years. We had a almost 2 year cycle to the downside from late 21 into late 22. As you mentioned before, from October of 22 through now 2 years, we're below average for the market return during a bull market cycle. Do we really get to be that surprised if we have quote unquote surprise upside? Probably not. And this is all happening with a dollar that's rising.
A dollar that's still
above 100.
Yeah, I mean, we try. I mean, how many times we try to break 100, and now we're back to 1 month highs in the dollar.
Right.
And maybe that's the healthiest thing. Maybe we get a range bound dollar between 100 and 105, 106. And the market says, yeah, I'll take it. Pretty range bound for most of 2013, 24. Those were good. We've had good markets in range bound dollars.
Yeah.
With a range bound dollar.
Right. And that goes back to the market enjoys stability of the inputs or a cooling of those inputs. And so if you have a range bound, a stable dollar, that's not, or a grid, let's call it a gridlock dollar, because I'm about to take this to politics. The same thing, while the market doesn't have a favorite party, what we do know is when we have gridlock, we have division in the House and the Senate, the market likes that. Because guess what? The rules of the game aren't going to change. And so if we want to get on our fundamental soapbox, the idea that the input costs into a business is going to stabilize now makes the rules of the game a more known commodity, if I can use that term, commodity. That's not a bad thing. That's a good thing. Another thing for risk on, and yet we see skepticism. So we have all these technical analysis tools that we can use to do top-down analysis, even have a macro understanding of things that continue to check off boxes for risk on. Meanwhile, the narrative is focused elsewhere. The positioning is focused elsewhere.
A lot of angst out there. I feel the wall of worry is we got plenty of bricks right now.
Yeah, we're less than 30 days from a U.S. election, arguably the most powerful, we're electing the 5,000 most powerful people on the planet. So I understand the angst behind it, but the market likes to climb that wall. You have conflicts across the world, whether we're talking about Ukraine, the Middle East. We have
inflation just picked back up. What have we talked about? Inflation.
Yep.
Better be protecting that purchasing power. One of the best ways to do it is equities.
Yep. And we're coming off the backside of 2 hurricanes in the U.S. that have devastated areas. And so there's plenty of narratives going around that are negative. It's when the narratives start to shift towards this market can't miss, or it's bullish forever, or this time is different. And we don't have that yet. We don't have people positioned that way. We still have people stuffing money in money market funds. We still have net negative risk taking from fund managers.
I'll wait till after the dust settles from November.
Oh, right. You could definitely see that. Yep, I'm going to wait till after the election.
I'll wait and see where things stand. And if I personally agree with the elected official, then maybe I'll put some money to risk. But if I think they're going to be bad for the economy because I just don't personally align with them, then I'm just going to stay in cash and T-bills.
Right.
Okay. I'm telling you right now, Kamala Harris gets elected and we stay in an uptrend. I'm going to be pretty aggressively invested. It's like,
right.
Sorry.
It is what it is.
I don't agree with her, a lot of her stuff. But what am I going to do? Sit in front of a client and say, well, I just really didn't like her debate performance. So we decided we were going to be really protective with your investments for the next 4 years.
Well, and remember that some of the quote unquote, I'm not saying they actually are, but quote unquote smartest people on the planet were saying the market was going to crash if a Trump was elected in 2016.
Oh, yeah. I think Krugman said move all your money to emerging markets.
Yeah. Was that not a lesson in don't listen to the talking heads, listen to the market? If the market doesn't like a candidate, we'll know.
We will know.
It's math. It's price. Price moves on a chart. If we're below certain levels, if we're below a 200-day moving average, if we're below 5,600 on the S&P, if these equal weight products are below their previous high, that will be information that's saying, okay, maybe the bullish thesis needs to be reevaluated. But until then, you could have either candidate elected And the market's going to do what the market's going to do, regardless of your opinion of that candidate. I'm not saying your opinion on that candidate is not important, that you shouldn't vote. You should. But whether it's reflected in the market or not, you're talking about two different data inputs. One is the collective opinion in the market, and one is your own individual opinion. And a lot of times those are actually at a juxtaposition. Market doesn't care a crap about your opinion. Go ahead.
No, yeah, 2017. I mean, they had everyone convinced 2017 was going to be the most insane year in markets. Because the orange man now, I mean, dude, all he's got to do is push the button. We could have a nuclear war tomorrow.
Mm-hmm.
It was, by basically every single measure, the least volatile market in the history of the stock market. For a least volatile year.
Yep.
I mean,
you had the least volatile market. So we went from it's going to crash to one of the least volatile markets on record. In addition, the war drumming that was going on at the time, we had ISIS gone within 2 months. We had no other conflicts that we engaged in. So this quote unquote warmonger turned out to not be that. And so you always have to see the end result, not your opinion of it. You have to watch the market, not your opinion of it. It's a very distinct two different things. You have to see the scoreboard rather than your opinion on the team. Because inherently, I think humans are negative by nature. Your team could win a game and you're still going to find negatives. Like there's no such thing as checking all the boxes, even though I would make the argument that right now is the most boxes I've ever seen checked for a bull market. And people are still going to find negatives about it because that's human nature. But in the end, the trend's the trend. The Chiefs are the Chiefs. I mean, the Chiefs have won how many Super Bowls now in the last 5 years?
They are 3.
That's the trend. Like until that changes, it's status quo. Until these other things start to bear their heads differently, such as credit markets, the areas of the market that we're seeing perform, until those change, it's a bull market. You'll always be able to find something. It's the weight of the evidence. And the weight of the evidence, if you look at it on a scale, and if that scale was divided up into bull market and bear market, most of it is sitting on bull market. And not surprisingly, we're seeing bull market continue. If that starts to stack the other way, fine.
Yeah, you want to see credit spreads spike. You want to see, I mean, let's just basic relationships where, Ian, should I be in just cash and cash equivalents, or should I be in stocks? Pull it up on your computer. You can answer that in 5 seconds and then go on about your day. Yeah, until those change, and this was to your original question 5 minutes ago. I'll continue to say there's just not a lot out there. Not as much as there was 3 weeks ago. Lots of relationships that just fix themselves in a bullish manner, which we would expect. They've been bullish, July, August, September, kind of wonky for a lot of some areas. What about the whole yen thing? That is gone. Golly, we talked about that for 48 hours. That was supposed to be the big credit event. I guess, I don't know, maybe it ends up being a credit. I don't know, but I do know the S&P is about 8% higher since then.
Right.
5, probably closer to 5-ish, but
so we continue to see all the weight of evidence suggest ongoing bull market. That doesn't mean it eliminates volatility from the market. Meaning, again, if we just use something simple like the S&P 500, we're currently sitting about 9% above a rising 200-day moving average. Could you still see corrective behavior of 9% from today through the end of October, and you still have the bull market thesis alive? You could. And would that feel good? It wouldn't. To some. Would it be normal? Absolutely.
Would be normal. I'll give you one. Most momentum indicators from the mid-July highs, we've got divergences.
Okay.
So you look like an RSI I mean, we have not gotten back to overbought on a daily RSI since July 15th. But yet and that's fair. Like, we did, one caveat I give this is it's an RSI. We did go. This is much better than we got a divergence. And for the last 3 months, we were in an uptrend. I mean, we really have been sideways up until about 2 weeks ago. So does the divergence kind of make sense? Yeah. But again, I mean, that goes to, like, if you got to make me go fish for something, maybe I'd put that in my something to watch bucket. But
and divergences can last a long time.
can.
And we haven't seen, and the other way to use RSI is we haven't seen RSI get oversold in the S&P 500 for well over a year. And there's the leaders. So if we just look at the leaders, something like NVIDIA, we're still sitting in a bullish range. Or you look like at an Eli Lilly. When you look at Eli Lilly, you have an RSI that's in a bullish range. And that's not negative. So the divergences are there, but you've highlighted, I mean, since the beginning of this podcast, really, that divergences are to be aware of, but also they can also last a very long time. And they're not really confirmed as being an issue until we're breaking prior lows or breaking some trend metric like a 200-day moving average. And we're just not seeing that.
We're not there. There just isn't a lot of warning signals. There are a lot of canaries in the coal mine, and a lot of them are flying back out alive.
Yep. And so there's really not much more to add. I do want to highlight the supporter of this podcast, the Adaptive Select ETF, listed on the NYSE under ticker ADPV, which helps investors access to the most prevalent factors in markets, momentum, and relative strength. It uses proprietary identification methods, which allow Adaptive Select ETF to attempt to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing always involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. So with that, Ian, we're towards the end of our time together. I always appreciate doing these with you. I know our clients appreciate it. We hope our listeners appreciate it. Anything else you want to highlight for our listeners before we sign off?
No, I just think beware of the opportunity cost between comfort and simple risk taking. There still continues to be a lot of comfort and it's fair in getting 4 or 5% off of short-term T-bills. And that's for sure, I mean, better than anything than we've seen in my career. But also be aware that we are in a bull market and there's other opportunity costs with the simple risk taking of trend following that I believe is still a better option in this environment. It's really easy. You're right. 5% risk free that's great. It's great. But being involved in uptrends using simple filters also can net you a lot more in this environment. And has been, right? I'm just saying this. I mean, we've been here for 2 years.
Yep. Well said. I don't have anything to add. The evidence continues to suggest further upside that doesn't eliminate normal market volatility, such as a 5 or 10% move down to a 200-day moving average would be perfectly normal. But that would be probably the exception to the bull market behavior that we're seeing. Heading into, we're only 20 short days away from the best 6 months, seasonality speaking, and we could take that data in when it comes. But we continue to see the boxes checked. We continue to see bull market behavior. And until that changes, that's what we have to default to. It's just as simple as that. And so we appreciate everybody listening. Share this with your friends, family, give us a high ranking. It's a way that you can pay a compliment to us if you appreciate this information. So thanks again, Ian, for being on here with me.
Have a great weekend, everyone.